not let banks and lenders off the hook when it was their greed and irresponsibility that partially got us into this mess. We should not be bailing out just Wall Street. We should be restoring opportunity on Main Street.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers, and we're going to ask the question, is the Great Depression canceled? And despite what you just heard from Obama, I'm going to tell you guys right now, the politician and the authorities continue to bail out the banks and take that bill and take that expense and drop it right on top of the heads of Americans. We had a lot of activity happen on Monday. Today's Tuesday. The industry is already making excuses for what happened on yesterday with the massive decline in the stock market. Now, according to Market Watch, it has nothing to do with the markets being overvalued. It has nothing to do with how much the consumer is suffering. And it has more to do with Schwab, Fidelity, and E-Trade suffering outages during Monday's stock market sell-off. So again, they're already saying that the reason for the massive bloodbath yesterday is because of a glitch. Today I'll present you guys data on how the decline yesterday was just the tip of the iceberg. Along with the data, I'm going to take us on a trip to the past, and we'll hear from Obama, George Bush, a little bit of Trump, and Ben Bernanke to help us remember where we came from. Let's start by listening to Obama, and I want you guys to pay attention to how on one hand he's saying that he wants to save Americans, but on the other hand, these politicians bail out the entire banking system. And the attitude, I believe, is extremely dangerous because, again, they're telling us one thing, but doing another.
They're working hard. They're acting responsibly. To the extent that they were involved in any of this, it's that some mortgage broker tells them they can afford a house that they don't know. It looks like they can afford it. And suddenly, folks are getting wiped out.
The fact of the matter is politicians do rob us, as well as the banks, from the American dream of home ownership. There's no doubt in my mind this type of fraud, corruption, and deceit and manipulation is happening, and it has been happening for as long as I can remember. So if we have history of being lied to, then why do so many people in the market right now trust and have faith in the system? To me, that's a recipe for disaster. The banks put themselves in a position to wipe us out, and the way they do that is taking ridiculous amounts of risk. Commercial real estate is massively impacting the financial sector behind the scenes. Those challenges are unraveling like crazy. The fact that more banks haven't gone out of business is shocking to me. But one thing I want to point out is that commercial real estate economy added 2.8 million jobs to the market, and that's as of November 2023. When the commercial real estate meltdown finally collapses, understand that there will be additional layoffs just from commercial real estate. Just like the past, many of these regional banks are barely hanging on. In fact, guys, I'll say the entire banking system right now is insolvent and bankrupt. But when we take a look at the holdings from small banks versus large banks, there is no comparison in the reckless investing that small banks do. The small banks are sitting with almost $2 trillion in commercial real estate, whereas the large big banks only have $879 billion. Back in 2008 and 2009, there was a mortgage bank or a regional bank that was closing on every single corner. Take a look at this, guys. These are the net charge-offs. This is absolutely spiking. Now, if you look here, the total commercial real estate loan net charge-offs exploded 4,138% year over year to $1.17 billion in the second quarter. And I'm telling you guys that because there's an entire Ponzi scheme going on behind the scene right now with these lenders and with their horrible commercial real estate assets. And what they are hoping, I'm going to tell you guys right now, they are hoping that the Fed is going to bail them out and that you and I will have to pay for that. And again, what I'm saying is we just can't afford to pay for this any longer. So has the Great Depression been canceled? Absolutely not. What we saw yesterday is before we've even confirmed recession, before credit tightening has even happened, before any type of spike in foreclosures has happened. When home values start going down, it will collapse the entire economy. Remember what George Bush told us.
Decline in the housing market set off a domino effect across our economy. When home values declined, borrowers defaulted on their mortgages, and investors holding mortgage-backed securities began to incur serious losses. Before long, these securities became so unreliable that they were not being bought or sold. Investments banks such as Bear Stearns and Lehman Brothers found themselves saddled with large amounts of assets they could not sell. They ran out of money needed to meet their immediate obligations, and they faced imminent collapse. Other banks found themselves in severe financial trouble. These banks began holding onto their money, and lending dried up, and the gears of the American financial system began grinding to a halt. With the situation becoming more precarious by the day, I faced a choice: to step in with dramatic government action, or to stand back and allow the irresponsible actions of some to undermine the financial security of all. I'm a strong believer in free enterprise, so my natural instinct is to oppose government intervention. I believe companies that make bad decisions should be allowed to go out of business. Under normal circumstances, I would have followed this course. But these are not normal circumstances. The market is not functioning properly. There has been a widespread loss of confidence, and major sectors of America's financial system are at risk of shutting down. The government's top economic experts warn that without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold. More banks could fail, including some in your community. The stock market would drop even more, which would reduce the value of your retirement account. The value of your home could plummet. Foreclosures would rise dramatically. And if you own a business or a farm, you would find it harder and more expensive to get credit. More businesses would close their doors, and millions of Americans could lose their jobs.
Home values are a huge part of the financing sector. Now, that's not fair for us as Americans. The fact that not only our elites, but our government officials are essentially throwing all of their debt on top of the backs of our houses is something that we're not going to take. And even if we wanted to, we can't afford it, guys. We can't afford to keep this going, and we can't afford for the government to keep intervening. We need to stop government intervention. And the reason I'm saying that is not only are they devaluing the currency, in my eyes, when we look at the Austrian School of Economics, all of this government intervention is making the problem worse and will make the collapse even more severe. The government deficit for the fiscal year of 2024, it's not even the end of the year, guys. We're already at $1.26 trillion spent of money that we don't have, of money that we are going to have to pay and our children are going to have to pay. That's not fair. The amount of mortgage-backed securities being purchased from 2020 to 2022. This right here, you guys, what I'm pointing out right here is un-American. This is why interest rates got so low. It wasn't necessarily that the lenders wanted to help us and give us 2% interest rates. It's just that the government was there saying, hey, give these people 2% interest rates. We'll buy those loans and you guys keep doing it. And essentially what that created is a golden handcuff effect and completely split homeowners between 2022 and before. They completely ruined home buying for any new home buyer right now. And that's another thing that is not sustainable. That is going to kill these regional banks just as soon as America starts to wake up to the fact that they never should have purchased a house.
The Fed was created to address financial panics, and its independence and its ability to act quickly is a key feature of what the Fed is about. And if we had not done that, and if the financial system had imploded and the economy had plunged into even a deeper depression, I think the populist reaction would have been pretty bad as well. So we were kind of stuck one way or the other. So we did the right thing, I hope. We tried to do the right thing. And there certainly has been pushback. We hope that as the economy improves and as we tell our story and as more information comes out about why we did what we did and so on, that that people will appreciate and understand that what we did was necessary, that it was in the interest of the broader public. It was a Main Street set of actions aimed at helping the average American. And as time passes and that becomes clearer, I'm hopeful that these political concerns will wane. That being said, the reason the Fed is independent is so that it can take emergency actions or any other actions, policy actions, independent of short-run political pressures. And the day that we allow those short-run political pressures to make us do something which is not the right thing for the economy, then our independence at that point is effectively gone.
He's saying that they did the right thing. Let me know if you think that the Fed did the right thing. I'm showing you guys this because for the past few decades, they've been moving us into a more Keynesian type of economy. And that's just not how the US was built. But all of this intervention, you guys, is sickening. And they did it in 2023. Take a look right here, you guys. What you're seeing here is an increase of about $400 billion. So during quantitative tightening in 2023, they did an injection of roughly $400 billion, and that was called the Bank Term Funding Program. This is horrible because the problem still exists. All they're doing right now is throwing money at problems and coming up with a temporary fix. And I'm telling you guys, and what we saw on Monday was this problem starting to fall apart.
Mr. Chairman, the financial markets are in quite fragile condition, and I think absent a plan, they will certainly get worse. But even at their current state, they are not serving the necessary function to support the economy. Credit is not being provided. Secretary Paulson mentioned non-financial companies are not able to finance themselves overnight. Credit is just not going to be available. It's going to also affect savers because of the value of their assets that they have. So even in the current condition, even if things don't get severely worse, but I think they would get worse without some kind of action, this will be a major drag on the U.S. economy and will greatly impede the ability of the economy to recover in a healthy way. Two things. First, as a minor point, that one of the things that this program being discussed could do would be to purchase second liens, which have proved to be a very significant barrier to the resolution of foreclosures. But more importantly, the housing market is not going to recover if the economy is declining, if jobs are being lost, if credit is not available. And so I do think you cannot separate these as two completely separate issues. You need to have financial stability and financial markets working properly for the economy and the housing market to have a chance to recover.
All of this fraud, all of this greed, all of this corruption, they try to sustain it. They try to normalize it when really what needs to happen is they need to flush the corruption and fraud out of the markets, out of the system, out of the economy. But the issue is, the reason why that doesn't happen is because the politicians are also corrupt liars. The corruption is so embedded systemically, you guys. Look at this chart. Home prices versus income, or rather Case-Shiller versus CPI. And right now, and this is why I'm saying everything is going to fall apart right before our eyes. It's going to start slow and it's going to happen suddenly, just like we saw on Monday. But you guys, and one of the reasons is we're in a double bubble. I can't express how big and unaffordable the bubble really is. We already had a bubble going into 2019. The PE ratio right now, the price to earning ratios, is out of control. The payment to income ratios also out of control, and they're not even counting insurance and taxes. And so again, I tell you guys, this entire system is set up and designed to fail. And the moment that it fails, they want to put that bill and they want to put that pain right on top of us and right on top of our homes. But I'm trying to tell you guys, there's just no more room. And not to mention, these guys are always wrong. All of the bulls, all of the politicians are always wrong right before recession.
Ben, there's been a lot of talk about a housing bubble, particularly, from the Fed, from all sorts of different places. Can you give us your view as to whether or not there is a housing bubble out there?
Well, unquestionably, housing prices are up quite a bit. I think it's important to note that fundamentals are also very strong. We've got a growing economy, jobs, incomes. We've got very low mortgage rates. We've got demographics supporting housing growth. We've got restricted supply in some places. So it's certainly understandable that prices would go up some. I don't know whether prices are exactly where they should be, but I think it's fair to say that much of what's happened is supported by the strength of the economy.
Tell me, what is the worst case scenario? So we have so many economists coming on our air and saying, oh, this is a bubble and it's going to burst and this is going to be a real issue for the economy. Some say it could even cause a recession at some point. What is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis. So what I think is more likely is that house prices will slow, maybe stabilize, might slow consumption spending a bit. I don't think it's going to drive the economy too far from its full employment path, though.
So would you agree with Alan Greenspan's comments recently that we've got some areas of the country that are seeing froth? Not necessarily a national situation, but certainly froth in some areas.
You can see some types of speculation, investors turning over condos quickly. So those sorts of things you see in some local areas. I'm hopeful that, and I'm confident, in fact, that the bank regulators will pay close attention to the kinds of loans that are being made, making sure that underwriting is done right. But I do think that this is mostly a localized problem and not something that's going to affect the national economy.
This scenario envisions that consumer spending, supported by rising incomes and the recent decline in energy prices, will continue to grow near its trend rate, and that the drag on the economy from the housing sectors will gradually diminish. The motor vehicle sector may already be showing signs of strengthening. After having cut production significantly in recent months in response to the rise in the inventory of unsold vehicles, automakers appear to have boosted the assembly rate a bit in November, and they have scheduled further increases for December. The effects of the housing correction on real economic activity are likely to persist into next year, as I've already noted. But the rate of decline in home construction should slow as the inventory of unsold new homes is gradually worked down.
There's plenty of liquidity out there. He said it did not sense a lack of liquidity in the market. And he said, we're monitoring the markets, but didn't really make any conclusions. So he went as far as he had to go, but not further.
He also calmed the fears about the subprime market, which were rippling through Wall Street yesterday, and said, we're taking a look at it. But right now, it doesn't seem to be an issue, but we're watching it, certainly.
Yeah, that's exactly right. So let's first take a listen to what Ben Bernanke had to say about the economy.
So we expect moderate growth going forward. We believe that if the housing sector begins to stabilize, and if some of the inventory corrections that are still going on in manufacturing begin to be completed, that there's a reasonable possibility that we'll see some strengthening of the economy sometime during the middle of the year.
Nothing's changed. The whole qualified mortgage protection and everyone's saying that the loans are really great these days. No, they're not. And the reason I'm saying that is because the lenders never adhered to the law. They were violating qualified mortgage debt to income ratio the entire time. Take a look at this report from the CFPB. They did a research in 2018 and found that in 2018, there was 957,000 loans that exceeded 43% DTI. That's 16% of total loans, which means 16% of total loans were given to borrowers that could not, according to their own policy, they could not afford that loan. And so instead of them changing that, like we would assume that they would do to protect the consumers, they decided to change the policy to protect the lenders. And all of this bailing out of the lenders and all of these lies that we're told to bail out these lenders is sickening. I say let them fail, because the reality is we are the ones that are failing every time we lift them up. And we see it here in these numbers. This is the updated foreclosure information. Right now, 5.17% of people that have a mortgage are behind on their mortgage payment. So despite what Black Knight is saying, which we can't even trust these service providers, they're only saying the default rate, delinquency rate is 3.5. The reality is they're covering up that information, and the real delinquency rate is in the 5%. But it gets even more concerning when we look at the number of renters behind on their rent. More than 1 in 8 renters are behind on their rent right now, sitting at 13.1%. American consumers cannot afford to live this way much longer. What's going to happen is home prices are going to go down, defaults are going to skyrocket, and the entire financing industry is going to implode, because on top of this issue with our homes, we have all of these other issues to boot. I want to bring your attention to the fact that FHA really is the new subprime. Take a look at these delinquency rates, guys. This is FHA again. Now, with credit scores between 620 and 659, the freaking delinquency rate right now, guys, is 17.1%. 0.21%. My question is why are they lending to these people if 1 out of 4 of them are going to go into foreclosure? That is insane, you guys. And from 580 to 619, the delinquency rate is almost 22%. In other words, you guys, they cannot keep the system going. We cannot afford it as Americans, and this entire thing is fixing to collapse. And do me a favor, you guys, if you enjoyed this video, if you found my information helpful, comment below, let me know what you did find helpful. Good luck out there. Happy Tuesday. I hope you guys have a great week. And if you're out there investing in real estate, you guys already know I wish you luck, and I hope you win.